Welcome back, everybody, to another episode of Capital Clarity, our 37th episode. Rick, may the 4th be with you.
Nice. Oh, I didn't realize it was May 4th.
Yep, it is Monday, May 4th, 2026, 12:22 p.m. Yeah, May the 4th. I don't know. It's such a dumb holiday, but
Star Wars. Everybody loves Star Wars.
I'm a Star Wars person, so
Yeah,
I'll be
most
watching.
people.
You know, I plan on watching the third one. Well, I know you're going to say it's not the third one. The third one.
It's not the third one.
Revenge of the Sith tonight, because that's my favorite one. But all you Gen Xers. Oh, it's not the third one.
The third one is Return of the Jedi.
Then what is Revenge of the Sith? Is that
It's the
negative
one.
-3? What is?
You go by storyline. I go by release. I get it. You're actually more right than me. I just can't change my mind on that sequence. So all good.
I know we usually talk about movies at the end, but since we're on it right now, I think in this order, these are my top 3 Star Wars movies. Revenge of the Sith, where Anakin turns into Darth Vader, and then Empire Strikes Back is
love that.
It's got to be the second. The scene on Hoth with the Imperial Walkers. That's just such a classic scene. And then I think an underrated, under the radar one is Rogue One, which technically it's newer, but it made in like the last 10 years, and it takes place in between Revenge of the Sith and A New Hope when they're building the Death Star.
That is a good one. I had to think about that, but yeah.
You ask people about that movie, and they go, the new Star Warses are not great, but that one holds up. That one's pretty good. Yeah,
that's good. You got to think about Empire Strikes Back. When they had the Hoth scene, the ice planet, at the time when that movie was released, it was mind blowing. I mean, today we're in a world of AI and special effects and stunts. It was mind blowing. You're like, how did they make this? This looks so real. Is it real? Are those Imperial Walkers real? So it was really cool.
I mean, that was probably the 80s that came out, late 70s, early 80s, maybe.
Yeah, I think, you're right. Early 80s, late 70s. You're right. Because I think,
that had to blow your mind, especially if you're like a teenager when that comes out, or a kid. Like, that had to just baffle you.
Yeah. Hey, we went to a wedding this past weekend.
Did.
Great family, great wedding at the Union League. Had to show you the picture, everybody.
That's such
fun
a great
time.
picture. Really fun time. Amazing venue. I felt honored to be there.
Yeah, Union League in Philly is really, really special. Really good time to be there.
My face looks so red in that picture.
You're at a wedding. Various reasons for that.
All right.
Hey, I thought this was interesting real quick before we kind of get started.
Yeah. I'll kick us off then.
I was reading a blog post called The Early History of Reuters. And Reuters is a news dissemination service and has been for a couple hundred years at least. A lot of it's market news and capital markets. But check this out. It was in that post I saw that traders used actual birds in the 1800s to beat the market. So before telegraphs were widespread, some traders made fortunes using carrier pigeons to fly stock prices between cities faster than competitors.
Really?
So they said, if your edge today feels thin, remember someone once beat the market with a bird. Kind of cool, huh?
That's amazing. My gosh.
Yeah.
I love history like that. That's so great.
That edge is gone. Carrier pigeon edge has been arbitraged
I don't think
away.
that wouldn't hold up anymore, would it? I don't think that's something that would efficiently challenge the market.
All right. What are we on to? Enough of my rambling.
Speaking of history, I always bring this up every early May. This week, always May the 4th, Cinco de Mayo, and how sell in May does not work. And this is from Carson Group. And they're saying, for those of you listening, they're saying, yes, the worst 6 months are coming up soon, May through October. But these 6 months have been lower only once in the past decade. And last year was the greatest sell in May return ever, with an increase of 22.8% in the S&P 500 index. We are expecting another strong return this year. I mean, going back to 2016, 10 years, there's only been one down period from May to October, and it was in 2022, and that was a rough year overall anyway. I mean,
Yeah.
There's no evidence to support the sell in May and go away idea.
Well, it used to work. It's like a lot of things. It used to work. It worked for a while, and it became, it rhymes. It became catchy. Hey, look, this works too, and it's fun to say. And then it stops working for a lot of reasons. One of the reasons that a lot of these things stop working is because people recognize it and start doing it earlier. Well, I'll sell in April. I'll sell in March, and before you know it, it's not working. There used to be a thing called buy the January effect, and it was, small cap stocks, small company stocks outperform in January. And it worked in like the 80s and the 90s. And it worked for a period of time because there was tax loss selling in December that pushed down the beaten up small cap stocks. And so they were due for kind of a rebound. And that happened in January. And then ETFs launched and traders got ahead of it and it kind of killed it. And the January effect doesn't work anymore. It hasn't worked in years.
Interesting.
There was also value beats growth. Always buy value stocks, the inexpensive stocks. This is also how Warren Buffett made his fortune. I mean, last 20, 25 years, Warren Buffett has been kind of matching the S&P. But prior to that, he always bought value stocks, really cheap stocks. And the idea was if you buy a stock that should be trading at $10 and it's trading at $7, you're always going to win, especially compared to growth stocks. Well, this stopped working in about 2003. Especially when technology stocks became the leaders in the market or even more entrenched leaders in the market. This sell in May is just another casualty of Wall Street where it worked for a little while. People thought it would work forever. No, it doesn't work anymore.
The average return for the last 10 years of the May through October period has been 6.9% for the S&P 500.
That's a lot.
That's a lot. It's a ton.
That's a lot, especially when you consider stocks do around, long-term 10, 11% a year. To do that much during that small window, that's not a window you want to miss.
No, that's a window you want to take advantage of.
Yeah, yep. So this might be a reason why sell in May. Who knows? I mean, May could be hard. We're in May now. We don't know. But if it's not, this could be a reason why it's not. Earnings. I mean, this piece from the Compound just shows the growth of earnings since the year 2000. Earnings per share for large cap stocks in light blue, mid cap stocks in dark blue, and small cap stocks in red. And they're all up and to the right and actually kind of going up and to the right even harder for 2026 for the expected earnings for this year. And we've said before, last podcast too, generally over time, stock prices follow earnings, whether that be up or down. And earnings are really, really strong. And it's not just the large caps. A lot of people are saying, it's just the Mag 7 or just the 10 big stocks or whatever it is. No, you can look right here. It's mids and smalls as well. The earnings growth is pretty strong. So,
yeah, I had a piece on earnings as well. But yeah, no, and that's I think it's better if I just show mine so I can parlay off that piece you just showed. This is from First Trust, earnings per share of the S&P 500 index. And they're saying over time, stock prices tend to follow earnings, and the path of earnings for the S&P 500 index tells a powerful story. In 2020, pandemic shutdowns caused a sharp drop in profits, with earnings per share falling from 162 in 2019 to 138, a decline of 15%. But that drawdown proved short-lived. Earnings rebounded quickly, reaching a then record of $207 just 1 year later. Since then, the trend has been steadily higher, with earnings per share climbing to a new peak of $273 in 2025. Yeah. I mean, it's a long way to say stock prices usually follow earnings.
Yep. And earnings
are companies
really
making money, then the stock prices will follow eventually.
Generally, yeah. Yep. And things are strong right now on the earth side. It's why this war and the geopolitical stuff feels like it's just delaying the inevitable, which feels like, and I could be wrong, but rising stock prices for this year, but we'll see. We'll see.
And then I've got this piece from the Compound here just showing the expected earnings growth by sector in the S&P 500. So basically saying, hey, over the next 12 months, over the next year, here's where we think the earnings growth is going to come from.
Look at tech.
No surprise that tech is leading the way at 34.3%.
Technology earnings growth. And they're spending so much money on artificial intelligence, yet the earnings growth is still expected to be very, very high.
Yeah.
So whether it be in spite of or because of the artificial intelligence, it's still amazing. So what's next? Energy was next.
Yeah, energy and then materials.
Yeah. The materials. Yeah, that makes sense. All right, so check this out. I don't want to spend too much time on it, but it's hard not to spend a little extra time on it. So I got this piece. It's from the
I had this too.
Did you? The U.S. Department of Education's National Center for Education Statistics. and it's a chart, a map of the United States showing the percent change in projected enrollment for colleges, universities. And if you're looking at this on video and not just listening to the podcast on Spotify or somewhere else website, basically every state other than the states that are in dark blue are expected to see a reasonable, if not large, decline in projected college enrollment. So it's most of the United States is expected to see less people enrolling in college. And Peter Mallouk says the enrollment cliff is coming. The 18-year-old population is expected to drop 15% between now and 2029. Expect many school closings and program downsizing. In some states, the casualties will be brutal. So what are the bigger ones here? 10%. Like California is about a 15.7% drop expected.
Look at West Virginia.
West Virginia's close to that, 13.5.
Is that Arizona?
New York State. That is New Mexico, right?
That's New Mexico.
Or is that Arizona?
Oh my gosh, our geography.
Exposing my geography foolishness. No, that's New Mexico. So yeah, it's kind of a big deal. And then I was doing some research after I saw this. So just very recently announced college closures. Hampshire College in Amherst, Massachusetts. It's a private liberal arts college. It's closing after the fall 2026 semester. So basically around Christmas time this year, they're going to close. They just announced that in just about 2 weeks ago. The reason for closing: declining enrollment, heavy bond debt, and so on. At risk of closing and likely to close: King's College in Manhattan, Sterling College in Vermont, and Penn State's already announced that they're likely to close a bunch of their Commonwealth campuses: Dubois, Fayette, Mont Alto, Shenango, Wilkes-Barre, and York. And then I also saw this. The Philadelphia Inquirer had this article just a week or two ago about Temple University. It says they've lost an average of $200 million annually as enrollment slides and retention rates are a major issue. Internal report from Temple says. So enrollments dropped 27% at Temple University over the last 8 years, falling from about 40,000 students in 2017 to about 29,500 last year. That's forced them to lose about $200 million a year in tuition losses. Temple expects to end the current year with $27 million operating deficit, and it's because they're losing money. They're drawing down reserves to cover ongoing shortfalls. So even locally to where we are, we're seeing this. And you and I have been saying for a while, something's got to break in the college pricing market because people will start saying no. And I guess maybe we're starting to see that where the system kind of corrects itself, you know.
I was just going to say, do you think this could be the beginning of that, or at least maybe not decline in prices, but decline in the inflation in college costs, maybe? You know,
probably
rather than going up at the drastic rate they have been every year. I mean, also, just speaking from my own experience, over the last year alone, I've had multiple clients who are new parents. You know, they just had a baby in the last year. Say to me, hey, I want to start saving for my child's future, but I am uncertain on if they'll go to college or not. Not saying they definitely won't, but not saying they definitely will. What do you recommend for that? Whereas I never really got that a whole lot prior to this year, and oh my gosh, I've had that said to me so much this year. So you definitely see a lot more new parents saying, I don't know if it's worth it to send them. You know, they might just go right to work.
Yeah, and I've seen that too. It used to be the default setting. No, they're going to college, and now it's like, well, we'll see. Peter Mallouk, one more quote from him: "You can't get $1 million mortgage if you make $100,000 a year. You can't get a $75,000 car loan if you make $35,000 a year. The fact that you can get $250,000 in student loans for a college degree where you're expected to earn $50,000 a year is unacceptable and a complete failure of U.S. society." And I can't say I disagree. It's pretty harsh, but
actually, couldn't say it any better myself.
Yeah,
that was It's stern but fair. You know.
Yeah.
Right. Well, it wouldn't be a podcast unless you talk about self-driving cars and I talk about AI. So I'm going to talk about AI. I saw this morning from from the Irrelevant Investor, basically showing AI-related stocks in the S&P 500 and their earnings per share year over year over the last 3 years versus non-AI stocks in the S&P 500 and their earnings per share over the last 3 years. The AI names are drastically outperforming the non-AI names in earnings per share year over year over the last 3 years, and are projected to keep doing that for the remaining quarters in 2026.
Yeah. So, I mean, the big fear has been that that the AI spending will be a problem, and it looks like it's not necessarily a problem. It looks like it's actually a tailwind.
Yeah.
I mean, we maybe not you so much because you're so much younger, but a lot of us old guys think, well, I've seen this movie before, the late 90s, when so many companies overspent on the build out of the internet and everybody was trying to become the next big tech giant. And so many of those companies overspent. So we have our guard up for, oh my gosh, now they're doing the same thing, but with AI. Well, back then, a lot of those companies overspent and never had the earnings come out the other side of the pipe. But now it seems like, at least we're in the beginning of it, but it seems like the earnings are coming from a lot of the AI spending.
I am so glad you brought up that comparison, because I have this from Prof G Media showing the expected IPO value of SpaceX, Anthropic, which is an AI company, and OpenAI versus all .com IPOs combined, adjusted for inflation. And between these three potential IPOs, it's already more than all of the .com IPOs combined, adjusted for inflation.
Wow.
How crazy. That's just three companies.
3 companies bigger than about 2,600 IPOs from the .com era. I mean, and it's adjusted for inflation.
And it's every single IPO from the .com era combined.
Wow.
Over the course of 5 years.
And there were so many, and that was the sweet spot of that too, 95 to 2000. Unbelievable.
Yeah.
And it's inflation. If it wasn't inflation adjusted, I'd have to start thinking in math, but it's adjusted for inflation.
Yeah.
Now, this scares me.
Prof G says we're looking at one of the biggest moments in financial markets in a really long time. Between OpenAI, Anthropic, and SpaceX IPOs, we're going to be inserting almost $4 trillion in value into the markets, while at the same time adding $0 in earnings, because all of them are burning billions in cash. SpaceX lost $5 billion last year. OpenAI is expected to lose another $14 billion this year.
Wow. Amazing.
Yeah. Double-edged sword.
Amazing. I have a very short listener question. So I had a client ask, and he's in his late 50s, maybe 8-9 years from retirement. And he said, what's the biggest retirement risk most clients underestimate? Which I think is a really intelligent question. What's the one blind spot that most people don't think about? And I'm sure I could, come up with some crazy answers and some specific, anecdotal scenarios. But I think the biggest one that applies to the most people is, and I think you'll agree, is inflation risk, which is also kind of longevity risk. The risk you outlive your money, but not just because you live too long, but because you retire at, say, 65 and have your income puzzle put together and go, yep, this is the income I need. I guess I'm all set for life. And then you start living your retired life. And over the course of 20 or 25 years, what it costs to live your life, the same life, not a better life, the same life, the cost doubles just because of inflation. So you go, okay, my income from my pension, Social Security portfolio is $100,000 a year. I guess I'm set. And you get maybe 20, 25 years later, and now it costs $200,000 a year to live the same life.
Yeah.
And so I think that's the single biggest risk people don't factor in, because inflation is such a ever-present phenomenon, but it's such a slow creeping thing day by day that, you can't feel it or see it as easily. And so I think that's the biggest risk.
That's why most people, even if they are retired, I say most people because some people have so much money and they spend nothing. So most people, even if they are retired, still need a small slice in stocks in their portfolio, because if you're all bonds, you're taking literally a fixed income into a rising cost society. And eventually that'll come back to bite you. And you don't want to have to go back to work when you're, 89 years old and can't do so.
We've seen that. We've had people refer to us where they're like, help my brother. got himself in a jam, bail him out, and he's in his late 70s, and it's tough to dig him out of that hole.
Yeah.
That's I love that expression you used, taking a fixed income into a rising cost world. True.
Yeah. I thought this was really interesting. The share of S&P 500 companies, so companies that are in the U.S. stock market, the S&P 500, that offer executive security. So 38% in 2025, 38% of the S&P 500 companies offer executive security. And this is from Prof G Media as well. I thought this was really interesting also because it's gone up drastically since 2021 when it was down at 24% of S&P 500 companies offer executive security. Seems like just more and more each year they're offering this.
Huh. I wonder why this is. So it's 2021 to 2025. So I don't know. I mean, obviously.
And what we're saying by, sorry, not to cut you off, but what we're saying by this is these companies offer protective details for their, high level
CEOs, CFO,
their executives,
the C-suite executives. Yeah, I don't know. I wonder if some of this is related to the sad shooting of the United Healthcare CEO.
I was gonna maybe suggest that being one of the causes.
I mean, let's face it, the bulk of CEOs, most of us couldn't pick them out of a lineup in terms of knowing their face or maybe even their name. The name's probably actually more knowable than the face. Even today, I mean, it's a little more visible today with the internet and so on, and interviews and podcasts and things like that. But still, I wonder, I don't know, that UNH CEO shooting might have been a big part of it.
But I feel like this
political
is a trend.
divide. People are so tribal. Is that part of it? Where somehow that's led into it? I don't know.
But I feel like this is a trend outside of these companies too. I feel like you're seeing all sorts of celebrities, even if they're not that famous, still having security. I mean,
right.
I mean, maybe I'm wrong. It's just I feel like that's becoming the case.
Well, I have broken this trend because I had a 5-person security detail, and I'm down to 2 now. They're 2 retired Navy SEALs, but I did get rid of 3 kind of slackers that weren't as good in their qualifying drills for the pistols. So
yeah. How much are you paying them?
I don't know. I had to attach it to your checking account, so it's coming.
Oh, great.
You. I don't have anything else other than a recommendation. So if you got more, go.
I got one more thing. Oh, I have a few more, but I just want to share this one especially. This will be the last thing I share. I saw this the other day. It's from, I guess technically from Warren Buffett, but I'm pretty sure it's Visual Capitalist that provided the image. And if you're listening, I'll rattle a few of them off. But 20 lessons inspired by Warren Buffett. And I mean, there's 20, but I don't want to, rattle all of them off. I'll just do the top 5 because I found those particularly useful. Number 1, read for at least a few hours every single day. I think that also gets lost in today's society with social media and Netflix and streaming in general. But
watching a 30-second video is not reading.
Yeah, read a book for a few hours every day, or an article or something.
Or reading tweets. That doesn't count either.
These next 2 I found very insightful. Guard your time. It's the one thing you can't get back. That whole can't take it with you when you go. Time is really you're the one asset. No one, no matter how wealthy you are, can ever get back. It sounds no one knows when we're going to go. It's just protect that. Yeah. And in that same thought, say no to almost everything. Now, obviously, you don't want to miss really important things in life, but I think people can become people pleasers and not look out for number 1. And I think that's a really good one. Number 4, know exactly what you're good at and stay inside it. Yeah, perfect your craft.
Yeah, I'll tell you, when I was a trader on the floors of the exchanges, that one applies to that so well. We would have 10 men and women trading in a trading pit, and all 10 might trade differently, but all 10 would succeed because all 10 of those people knew what they were good at and bad at, and they did the good things and stayed away from the bad things. You could be standing next to somebody who was good at the thing that you're bad at.
Yeah.
And, like I was really bad at shorting stocks, and I stood next to a guy who was incredible at shorting stocks. And I'd just shake my head when he would make money doing it. And I'd laugh because I'd go, I don't know how you do that, but stay in
Well,
your lane.
well, that might also play into number 9 here. Never stop learning. The more you know, the better you decide. So,
Yeah. And learning about yourself. That's the
yeah.
thing. We're all strong in things and weak in things. We're human. The more you know about your own strengths and weaknesses, the better you are at whatever you're doing.
And then I'll mention one more that really plays into our business. Live below your means no matter what you earn. I think that's a good one. People, especially when they start making more money, tend to live way outside their means because
Yeah.
they get beer muscles from what they have.
Yeah.
Meanwhile, it's no matter how much money you have,
Yeah.
never live above your means. I think
I
that's a
just
good
got a
one.
$300,000 bonus for this year. It was unexpected. I just bought a banging boat. It's that kind of thing where you go, oh, maybe, okay, I don't know. Maybe it was okay, but don't make it a
Yeah.
constant habit. If you get another one next year, maybe save that one.
Yeah. Yeah.
That's well said.
But if you're watching, these there are top 20 here. But if you're listening, I think those are some of the most important ones to take away. Oh wait, I'm sorry. One more. Avoid debt that funds lifestyle instead of growth. That's a good one, I think.
Yeah. No, that's the boat thing. I
That
mean,
yeah,
yeah. I mean, debt like that. Warren's saying, hey, borrow money if you can turn it into more money. Whereas if you borrow money to buy a severely depreciating asset of some sort, maybe that's not the greatest thing. That's
yeah,
lifestyle. Yeah. Yeah.
yeah.
You got more? Keep going. I don't want
Oh,
to
I have a recommendation
embarrass.
too, but I'll let you go first.
All right. So Warren Buffett said we need to read more than we do. And I told you, I think last podcast that I started watching that the Men Who Built America, the Frontiersmen. So what did I do? Naturally, I started reading this book on Daniel Boone. So this is a biography of Daniel Boone by Robert Morgan. It was written, I forget the date, but in the last 10 years. It's much more recent than the one I'd read prior to this, which I think was written about 20 or 25 years ago. The first one I read was sort of a dissection of Daniel Boone. It wasn't very exciting. It read almost like a Wikipedia page or something like that. This one tells the same stories, gives you most of the same information, but does it in a great storytelling fashion. It's almost like this book was written by Hollywood, and the other one was a basic documentary done by me with with my iPhone or something. So this is a great book. Boone, a biography written by Robert Morgan. If people are interested in Daniel Boone or the frontiers of America, Daniel Boone is, you might think of Daniel Boone from maybe some Disney special from a long time ago or some cartoon or something like that. His life was so much more broad and interesting than any of those short clips can capture. So great book.
Wow, your recommendation is so much more intellectual than mine. mine's dumb, but it's fun. It's a movie. Watched it yesterday. It's on a few streaming services, but I watched it on Prime. Greenland 2. So yes, there is a Greenland 1. Basically, the premise in the first one is there's a asteroid that's coming towards Earth, and Gerard Butler, who stars in it, has to get his wife and son from Georgia, where they live, Georgia in the U.S. that is, to Greenland, where there's a military grade bunker that can protect them from the blast of the asteroid. And this is the second one that picks up while they're in the bunker where the first one ended. Spoiler alert for the first one. But
I never saw the first one.
It's a fun, if you're into the action thriller apocalypse movies, it's an entertaining one.
Yeah, I mean, you know me, I love most movies, and I would watch this. I mean, Gerard Butler. I love Gerard Butler. So
It's
ever
fun.
since 300, I
Yeah,
love Gerard Butler.
fun is what I would use for it.
Yeah,
Yeah, nothing too gory or anything either. It's a thriller,
yeah.
end of the world
I'd watch
thriller.
this. I'd watch this. All right, good. Thanks. Now I have to watch both.
We got listener questions this week, which is awesome. Please continue to send them to us. We will answer them. So, all right, everybody. We'll see you next time. Thank you.
Bye.
The Capital Clarity podcast is presented by FA's Keith Wagner, AA.MS Financial Advisor, and Rick Wagner, CFP, Senior Vice President, Wealth Management. This podcast is for informational purposes only and is not intended to be taken as financial advice. All opinions expressed are of the hosts and do not necessarily represent those of Raymond James. Opinions are as of this date and are subject to change without notice. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Prior to making an investment decision, please consult with your financial advisor about your individual situation. 2003 South Easton Road, Suite 100, Doylestown, Pennsylvania 18901, 267-742-3455, Raymond James and Associates Inc., member New York Stock Exchange SIPC. The S&P 500 is an unmanaged index of 500 widely held stocks that is generally considered representative of the U.S. stock market. The Dow Jones Industrial Average, DJIA, commonly known as the Dow, is an index representing 30 stocks of companies maintained and reviewed by the editors of the Wall Street Journal. Inclusion of these indices is for illustrative purposes only. Keep in mind that individuals cannot invest directly in any index, and index performance does not include transactions, costs, or other fees which will affect actual investment performance. Past performance does not guarantee future results. 529 plans come with fees and expenses, and there is a risk they may lose money or underperform. Most states offer their own 529 programs, which may provide benefits exclusively for their residents. Please consider whether the state plan offers any tax or other benefits. Tax implications can vary significantly from state to state.